As a result of the intricate web of factors that influence the economy and interest rates in general, it is difficult to anticipate the future rate environment with complete and utter accuracy. However, there are currently no indications that interest rates will be decreasing in the near future, and the Federal Reserve has stated that it will continue to raise interest rates in 2023. In addition, it is always a good idea to concentrate on the basics that will place you on solid financial footing, even if the economic outlook unexpectedly turns in a different direction. Because of this, now is a good moment to reevaluate your strategy for saving money and to take a good, hard look at your debt, particularly debt that has an interest rate that is variable. Accounts for savings are yielding higher returns. When the epidemic was at its worst, the amount of interest that could be earned on money that was locked away in a savings account was practically non-existent. Even high-yield savings accounts often had annual percentage yields, APYs, that were lower than 1%. But in a world when interest rates are high, savings accounts have the potential to yield returns that are significantly more substantial. At this time, the finest high-yield savings accounts have interest rates that are more than 4% and do not charge any monthly fees. With no monthly fees and no minimum balance requirements, a UFB secure savings account can earn an annual percentage yield, APY, of up to 5.25% at the time of this writing. Not only that, but it is not the only account that provides large returns. Lending Club and Marcus by Goldman Sachs both offer high-yield savings accounts with annual percentage yields, APYs, of 4% or higher. What appears to be a paradox can be readily reconciled. The Federal Reserve could easily reduce its policy rate by 1 percentage point in the coming year without altering its motto of higher for longer. With the Federal Reserve's best estimate of a neutral policy rate, which neither boosts nor slows growth or inflation, being 2.5%, anything that is higher than that is effectively still exerting pressure on the economy. To use the language of the central bank, policy continues to be restrictive. The official Fed funds rate of the Federal Reserve is currently at the middle of the range of 5.25 to 5.50%, and the pricing of rates futures market indicates that it will be reduced to approximately 4.0% by the end of the next year. It would still leave the policy rate approximately 150 basis points above neutral, despite the fact that markets are already nervous about the possibility that anticipating cuts of that scale would be premature given the continuation of the slogan of higher for longer and the absence of a recession. Even if the rate were to reach 4.0%, it would still be much higher than it was before the tightening cycle began in March 2022. Furthermore, it would be approximately 1 full point higher than what the markets anticipated the rate would be at the end of 2024 just 1 year ago. If the federal funds rate were to reach 4%, it would still be higher than the peak of the previous cycle. It would be significantly higher than where it has been for the majority of the last 20 years, and it would still be the highest it has been in this particular period of time. The actual federal funds rate is, of course, increasing as inflation continues to decline further from this point without any policy rate reductions being implemented. And if the current core PCE inflation rates of 3.5% were to fall to the target level, then the Federal Reserve would be able to drop these rates by 150 basis points without ever having to reduce the real policy rate. This is another example of how the phrase higher for longer applies. He is a senior macro strategist at Exant Data and a former analyst at the New York Federal Reserve. That is probably the base case now in terms of likelihood, says Alex Etra. Higher for longer is always a function of your base of comparison. It is possible the Fed could still cut interest rates and still have higher rates than previously experienced or higher than had previously been anticipated, according to The Economist. Over the course of the past 30 years or so, a pattern has emerged. The Federal Reserve is maintaining its policy rate at the cycle high for a longer period of time than it used to. If the first rate drop occurs in May, as the pricing on the futures market implies, the 10-month gap that has passed since the last increase will be the second longest amount of time since at least the late 1950s. In terms of nominal and fundamental timelines, this may be considered to mean maintaining rates at a higher level for a longer period of time. The higher for longer line, which Fed officials have been pushing for a significant portion of this year, is, however, fading away from market thinking. On November 28, Federal Reserve Governor Christopher Waller dropped clues that interest rates would be lowered sooner than was originally anticipated. These signals were crucial. In prepared remarks and a question-and-answer session on December 1, Federal Reserve Chair Jerome Powell had the perfect opportunity to push back against that notion. Nevertheless, he chose not to follow through with his plan. Bond yields have suffered a precipitous decline, implied interest rates have plummeted, and the value of the dollar has weakened. To the extent that market-based indicators are concerned, the financial conditions have become significantly more conducive to expansion. Goldman Sachs Financial Conditions Index, FCI, is at its lowest level in 4 months, and the Chicago Fed's Financial Conditions Index, FCI, is at its lowest level since February of the previous year. Inputs from the financial market, such as money market rates, equities prices, credit spreads, the dollar exchange rate, and yields on long-term and short-term investments, are used to create these indices. At the same time that the financial conditions on Wall Street have become more lenient over the course of the past year, the financial requirements on Main Street have become more stringent. The Federal Reserve has raised interest rates by 525 basis points since March of last year, and a variety of Main Street indicators, such as the Fed's Senior Loan Officer Opinion Survey, indicate that the Fed's actions are having a negative impact. Bank lending requirements are becoming more stringent, loan growth is becoming negative, and the number of delinquencies and bankruptcies is growing. In the end, however, the most significant indicator of the state of the economy's financial conditions is the Federal Reserve's policy rate, and whether or not it is accommodating, neutral, or restrictive for the economy by and large. The summary of economic projections will be updated by the Federal Open Market Committee the following week. This update will include the median estimate for the longer-run policy rate, which has been 2.5% for almost 5 years, with the exception of a brief dip to 2.4% in the beginning of 2022. This indicates that a real neutral interest rate of 0.5% is necessary, which is the vague holy grail of central bankers known as the R-star. This is based on the assumption that yearly inflation recovers to the targeted level of 2%. Last Monday, the president of the Federal Reserve Bank of New York, John Williams, stated that certain models indicate that the current monetary policy is the most restrictive in the past quarter century. I expect it will be appropriate to maintain a restrictive stance for quite some time, to bring inflation back to our 2% longer-run goal on a sustained basis, according to what he stated last week. Room to reduce prices while maintaining a higher-for-longer stance. What do you think? Share with us in the comments section below. If you want to watch more of our videos, then do like, share, and subscribe to our channel before leaving.